Hi everyone, this is Zach. Welcome back to the channel. Today I'm going to be talking about how I use the value area high, the value area low, and the point of control to define trade location, and then pairing that with the footprint chart to find timing for my entries. Now to begin, what is the value area high, low, and point of control? How I find this is there's a couple of different ways of calculating these. The most common one is to do an RTH, which means regular trading hours volume profile, and using that for your value area high and low. So if I'm losing you, I apologize. Let me iterate what I mean. If you take a volume profile and you plot it from 9:30 a.m., the open of a day, to 4 p.m., the close of a day, it should look something like this. I've done the same for this profile right here. Starts at 9:30 a.m., closes at 4 p.m. This one right here, and this one as well, right? Let's clean that up. When you plot a profile, it should give you 70% of the given, it should highlight 70% of the traded volume on that day. How my chart calculates it is it turns that 70% blue. So if this is a pie graph of your volume traded on a day, this is 100% of the volume traded on a day. What value area does is it breaks that up and it shows you 70% and 30%. Now, these are algorithmic levels, and for whatever reason, they have great reactions because I think it's because everyone uses the same ones. So they're really helpful to plot on your chart and find good trades with. What I do is I I plot the volume profile, and then it shows me where the 70% ends. So that's up here, right here. And then the 70%, the lower half ends there, and the point of control is exactly right there. It's that purple. What I do is I mark them. So let me quickly mark these. Okay, so I have plotted the levels. You can see here, yesterday value high, yesterday point of control, yesterday value low. So that's for this day. And now let's fast forward to see how we reacted to these levels. Let me clean that up. You can see once we hit the level of, we opened right here, and once we hit the level of value area high, we got a big rejection reversal. To the other side, we hit value area low, and we got another rejection reversal back to the other side, right? So great trade opportunity, great trade reactions, good zones for reversals, and they're also good zones for breakouts. Let me zoom in a little bit to a lower time frame chart. And let us go to where the market opened here. This was today, this session we were talking about. Now, when we get more granular, you can see the trade opportunities setting up. When the market finally hit yesterday's value area high, there's one of two things that can happen. Either we hit it and we break out, that's called expansion away from value, or we reverse from it. Now, the third option is that we do a fake breakout. This is called a failed expansion. The theory behind failed expansion is that the market maker has tried to move price away, failed to do that, so now they have to take price all the way back to the other side of this auction, meaning they're likely to take it all the way back to value area low. Now, this doesn't happen all the time, but it's very high probability. I trade this play all the time, so take a look at it. Another good target for this rotational play is point of control. That's somewhere down here. So you're saying, yeah, that looks great, but how do I know whether or not it's breaking out or it's going to reverse once it gets around that level? What I like to do is I like to use a footprint chart. So if we take a look at a footprint, this was at 1017. So you can see once we hit this area above value area high, me zoom in more. There we go. Once we hit up here at value area high, there's one of two things that's going to happen. We're going to break out or we're going to reverse, right? Now, we want to see buying and continuation of that buying if we're breaking out, right? If we want to be longs. But once we break out, once we get above this level, all we're seeing is selling. Look at all the selling in this candle. 212 sold, 98, minus 158, something like that. You can see on this candle at 1016, there was minus 416 contracts sold on the delta. Now, why is there 416 being sold in an area that we're supposed to be breaking out from, right? That's a red flag right there. Then there's more, right? More selling. Now there's more. So how could you execute upon this? Simply put, you could say that if price gets back below 250, yesterday's value high, you'll short it with a stop at high of day. Let's check out what the RVR on that would be. Let's go to this chart to take a look. You can see if you short it right there with your stop as a new high of day, you've gotten good confirmation, you've waited for the level to be breached, and you've used order flow. You can, to a very high degree of probability, get 3R at your first target at YPOC, or if you want to be more aggressive and hold all the way to the other side, you can get about 5, maybe 6R, right? You can see the reactions, how exact they are at these levels. Once it hits it, it fails to do its breakout. It reverses all the way back to the other side, right? So there's a lot of setups around value area levels. There's a lot of theory around why they work. I can go into more detail about that in another video if you guys are interested. But I just wanted to highlight some examples, make a quick video of trade you could take using these levels. Yeah, I hope you enjoyed. Please do like, comment, and subscribe, and I will catch you in the next one. Bye.